guys. So in my previous two videos, we have spoken about asset allocation, how much to allocate. So in this video, I'll be telling you about the mutual funds which I am investing in, and these are my investments. So it's up to you. If you want, you can take it. These are my opinions. So consult your broker before investing. So the first one, which if you are actively investing in stock market, I would say better. Whatever you are, it's better to invest in a passive fund. So passive funds are like, because you don't miss out on the rally that's there happening. So because it's not practically possible to have all 50 companies, so mutual fund is best way, and it's very cheap also. So that's why first is my HDFC index fund Nifty 50 plan. So these it has given one, as you can see, 29 at 3.9%. So basically it's safe, because if you think that Indian economy is going to grow, then obviously Nifty will also grow. So that's the benefit of investing in this. So if economy is growing, Nifty is growing, then your mutual fund is also growing. It doesn't depend on much upon the person who's handling it, because it's not an actively managed fund. So if you see expense ratio, it's very low, 0.10. Fund size is also decent, and HDFC is a known name to everyone. So lower expense ratio and all these things. So analysis, if you do, it's obviously real nifty companies which they have in the same weightage. So all 50 companies they have. So yeah, and returns are taxed at 15% if you redeem before 1 year, and after 1 year you pay LTCG of 10% on 1 lakh plus. So if you make 1 lakh plus investment, so you can have to pay. So this I'm planning to keep at least for 10 plus years. If you're planning to invest, then I think Nifty fund is good. And then another passive fund which I'm investing in is Nifty Next 50. As you know, Nifty 50 has very large companies, and their growth from there will be very difficult. But whereas Nifty 50 Next 50 has companies that are growing and which can be potential Nifty companies in future. That's why I'm investing in them. If you see 1 year 18.97, and if you see all, it's given 8% returns. Again, it's linked to how economy is doing, and there are very good companies also in this. So we'll see that as well. Again, expense ratio is slightly higher than Nifty 50, and so it's UTI Nifty Next 50 and 0.33%. Fund size is also decent. And yeah, if you see the sector in this, and if you see the sector in Nifty 50, you can see a huge amount of it is financial, then technology and all these things. Whereas here it has a very diverse portfolio, like not much concentration in one. It has services, engineering, everything. It has like more sectors, and it's a more wider sector. Avani Supermarts, Adani Green, Infotech. So you can see performance of Nifty Next 15 last many years, and you can see they have also given good return. So this is another fund which I'll be investing in, and these are my two Indian index funds or passive funds. If you want, you can invest in more Nifty small cap, Nifty mid cap, but I don't want to invest in that because it's very huge, and the gains which one company make will be lost by some other company. But overall, it's a good, and it's very like volatile as well. So it's up to you if you want to invest. So these are two index passive funds of mine in equity market in India. Then I have an index fund in international market, because as I said, 15% exposure to international market as well should be there in your portfolio. So again, this is a fund of funds. So basically, they don't invest directly in stocks, but they have a fund which has already invested in the Nifty, the Nasdaq 100 companies in US. So Nasdaq 100 companies has companies like Tesla, Netflix, Google, Amazon, Apple, and Walmart, and all these companies. Walmart, I'm not sure. So these are like really huge companies, and they are very good stocks, and they have very huge growth potential. You can see 1 year it is given 49%, and like in all it has given 40% return for like past 2 3 years. And again, expenses is minimal, and yeah, as I said, there is a lot of potential for the companies that are there. If you want, you can check out Nasdaq 100. It has mainly like 48%, 49% technology stocks, and then there are few other stocks as well. So it's a good, even you can look for S&P 500, but if you see historical returns, Nasdaq 100 has done better than S&P 500. So Nasdaq 100 has the biggest 100 companies of US. So yeah, this is another index fund which I'll be investing in as an international exposure. And then so if you go to ELSS. So ELSS is a tax saver fund wherein you can use ATC deduction and save some tax money in this, so that you don't have to pay very huge taxes. So if you're in 10, if you're in very high tax bracket, you can invest accordingly and claim for ATC benefits. So these funds are equity linked saving schemes, as you can see, ELSS. And Mirai Asset Tax Saver Fund is the one which I've selected. So if you see 1 year, sorry, 3 years, it has given 16.64%, 1 year 33% return, and in 5 years it has given 23.29. That's phenomenal. And this is again the tax money which you will pay to government. Instead, you can put here and save it. Again, expense ratio is very low, and this is an actively managed fund, and expense ratio is actually really low. So if you see from 5 years perspective, it's there in one, then three, four. So it's doing pretty good. And yeah, if you see holdings again, they have high in financials, healthcare. So see all these banks again, like they're all almost like Nifty 50 companies except for few. And then yeah, you can see some few companies from outside Nifty 50 also. So they have, like I would say, like maybe like within Nifty 100 and Nifty within 150, like India's top 150 companies is what they're managing in. So it's a really good fund also. And if you see managers, this thing, he has an MBA in finance. So this is another Myra Asset Tax Saver Fund, tax saver because you can claim ATC benefits. But remember that there is taxing after, like, and it has 3 years lock-in period, and taxation is also there after like 3 years, wherein you have to pay tax that's equivalent to like LTCG benefits, and it's wait a second, somewhere around 10%, I guess. Yeah, up to 1.5 lakh you will get tax free under ATC when you are investing. Then lock in period of 3 years, then return will be taxed at 10%. Okay, 10% is the return. There is no LTCG benefit here. And then another fund which I've chosen for ELSS again, because like if you invest ELSS, if you want to claim up to 1.5 lakhs in one fund, it's literally, it's too much concentration. And the other reason why I've chosen Quant Tax Plan Fund is, I'll let you know, wait a second. So if you see returns 1 year 58%, phenomenal. Like 5 years, if you see 21%, that is 23%, this is 21%, and their expense ratio is slightly higher when compared to Mira Asset Tax Saver Fund, and their fund size is 35 crore, which is like really which is small, but it's growing, like it's gaining popularity among people. So yeah, and one more thing you should notice is I made sure that each fund is like, there is no same fund managing two or three of my mutual funds, because too much concentration with one fund house is also again a problem. So if you see total securities, like they have again of healthcare, they have highest weightage, then comes FMCG, chemicals come, it's a different sector all in all. Then if you see, it's, you see Tata LC, Fortis, Bharti, Sun Pharma, Stylum, HCL. As you can see, like their main weightage is to like some mid cap companies and Nifty next 50 companies. So they don't have much holding in Nifty 50 companies, and that's why I wanted to invest in this, because as you saw, all the three first, Mira Asset and UTI HDFC, most of them dealt with the top 100 companies in India, whereas Quantax is dealing with like smaller companies, I'd say mid cap companies, and their returns are also stellar. So I'm investing in the Quantax fund. Again, they have five fund managers, each from different from different finance or sectors. So yeah, 1.5 lakhs is up to which you will get benefit. Then lock in three, return will be taxed at 80%. As I said, this I have chosen because one is its ELSS, they have good returns, and their stocks, as you can see, as different from like whatever Mira Asset, whatever you saw, or UTI Nifty or HDFC Next 50. Very small correlation, or what to say, overlap is there between these funds. Okay, so these are two ELSS funds. Then we had three passive index funds. Now we have one more multi-cap fund. As I said, I don't want to invest in small cap or more mid cap index fund. Instead, I'll go for multi-cap funds, because they have to give 25% exposure to each of the sectors, with small cap, mid cap, and large cap. So that's why I've chosen PPFAs, and it's like popular in mutual fund market already. So it has given 18.3%, 5 years, 19.34%. And the other reason why I have chosen is, like as you can see, funds are decent, expenses is also decent. The main reason why I have chosen this is their holding. So if you can see, this is Alphabet, that is Google, then Amazon, Microsoft, then they have another Facebook, then they have Suzuki, that is from Japan, So they have like very huge diversified portfolio. Like they have foreign stocks, not just US. They have one from Japan as well, and they're doing 3%. Then they have all Indian companies and ITC persistent systems. Again, these are different. Indian Energy Exchange, emphasis Hero Motocorp. So yeah, so this is the reason why I have chosen Parag Parikh, because international exposure I have even one for Motilal as well, and then I'm getting around somewhere like 25% exposure from PPFAS. So that's where my target of 15% exposure to invest US market or foreign portfolio is done. And then they have good track record as well. And yeah, so their expense ratio is also decent for a multi-cap like actively managed fund. So this is my one multi-cap managed fund. So now we have done international is done. So Indian equity, there is still more. I'll talk about it. So the next one which I'm talking about is Edelweiss Balanced Advantage Fund, which is of direct growth. So a Balanced Advantage Fund, what they do is they have a component in debt as well as the equity. So they'll see timing, and according to timing, they'll adjust the debt to percentage in their stocks and their equity weightage. As you can see, as of now, equity is 75%, debt is 28.9%, and they have cash of negative 4.4%. That means like they have borrowed cash or something like that. So so maybe if you see like before March, when they saw that there was a crisis coming ahead, they would have increased their debt expand like weightage to like 75%, and equity they would have reduced. So it's an actively managed fund between debt and equity. So by debt they'll get downside protection, and by equity they'll get the returns which they are looking forward to. Again, this modified duration is 0.82 years. So this is nothing but like the debt market has a link with interest rates that the governments are offering. So if interest rates are very low, then the debt bond market will go up. So the weightage or risk factor, how much it's there, is what it's showing. So this is very low. So even if there is a huge change in interest rates, the way it has very like minimal effect on debt bonds which are held by Edelweiss Balanced Advantage Fund. And sovereign funds are those which are backed by government. There is no default probability in this. And if you see, they have equity highest weighted as of today, and they have good exposure to debt. So looking at timing, if they think that markets or stock market is extremely overvalued and there is a stock strike or what to say crash coming ahead, they'll shift their weightage from that to this. That is from stock market to debt. So yeah, so this is one more balanced advantage fund which I'm using for my debt exposure. I am not using any completely debt based fund because I want good returns as well. So I'm using balanced advantage fund. They give me the returns that is close to Nifty or stock market, and at the same time downside protection also. They have good downside protection because of debt instruments that they have. The next debt fund, or I would say like a hybrid fund, is Canara Robeco Conservative Hybrid Fund. So conservative in the sense they have more weightage to debt than equity. So if you see 3 year, it's given 11.0, 10.46%. That's pretty good. And I want you to all consider this, that like over debt market has been given like has given very high returns in last 1 year. That's because of falling interest rates. So yeah, always keep in mind that debt market debt instruments won't give as much as return as it has been giving right now. So again, if you see the expense ratio, it's 0.64, that's decent. Fund size is also decent. And then if you see their holding, they have equity holding of 22%, whereas debt has 59%, and I have cash. And if you see that government holdings are 29.6%, like that's pretty good. Like these are all backed by government, LIC, IRFC, so all these are good, and there are very less chances of default. So when it comes to bond market, you should see the weightage or concentration of sovereign bonds, because they have very low risk of defaulting. That's why it's better if you choose the funds which have good or a decent amount of exposure to sovereign funds. So this is my another choice, and they have good equity. Again, government of India equity, Dalmia Bharat Sugar. So they have good stock also. As you can see, Mr. Jain from IIT Kharagpur, IIM Kolkata, then business administration, And yeah, so this is another fund that is I'm looking into, and this gives me the debt component which is needed in my portfolio. So Canara Robeco Conservative Hybrid Fund and Edelweiss Balance Advantage Fund together, they contribute for my debt equity debt exposure, whereas PPFAs and Motilal Oswal Nasdaq 100 give for international exposure, whereas all the other funds little like HDFC Index Fund UTI and Quant Tax Plan and Mira said they have complete Indian equity, whereas PPFAS has little foreign exposure. So yeah, Indian equity is done, even international equity is done, and debt market is also done. The only thing left is gold. So now if we talk about gold, I would say SBI Direct Gold Plan Growth. It has 0.10%, 888, and SBI is a known name. If you see 3-year returns 15% for gold. Again, gold returns are behavior with gold price itself. If you can see when Nifty went down, this gold went up, it kept going up even 15% return. That's pretty phenomenal. So yeah, so these are the pros and cons, which is not much. In SBI they invest in ETF. So fund manager is Mr. Sharma. So yeah, these are my portfolio. That is SBI Gold Direct Fund and Canara. So HDFC Index, I'll repeat everyone. HDFC Index Nifty 50 plan. This is an index fund. UTI Nifty Next 50, again an index fund. Motilal Oswal Nasdaq 100 FOF. It is a passive fund. International market. Mira Asset Tax Haver. This is an ELSS fund, and they have good Nifty like 100 companies of India. Whereas Quant Tax Plan Direct Growth, again it's an ELSS fund, but they have mid cap exposure. That's why my overlap will be reduced. And PPFAs, they have international stocks as well, and a good return and pretty famous, and some multi cap fund. So this is one more. Then Edelweiss Balance Advantage Fund, they shift weightage of equity and debt market depending on the situation which they seem, right? So I don't have to worry about investing more in debt or less. That will be taken care by the fund manager. So this gives me the debt exposure. Canara Robeco, again it's a conservative, so they invest highly in hybrid, like I mean debt market. So they give me the much needed the debt component, and then SBI Gold Plan, which gives me very like downside risk protection. So this is my portfolio. This is what I am investing in. It's up to you if you want to invest. If you can follow the same pattern, like passive funds, then an ELSS, and then a foreign passive fund, multi-cap, then a hybrid fund, and then a gold fund. So it's up to you. You can do the research and take it forward. I will help you in the process. So thank you. And this is just my advice. And please take your own investment broker advice before investing. And yeah, thank you.